So after looking at dozens and dozens of e-commerce businesses over the years, I've noticed these three recurring patterns in terms of the profit leaks that are showing up. These financial blind spots, if you will, that keep showing up time and time again. First, these founders seem to approach inventory decisions without understanding and taking into consideration the full and complete costs of carrying that inventory. Second is that we tend to often see indirect and overhead costs creeping up over time. And third, I believe that a lot of founders operate on the belief that more products equals more profit. But unfortunately, a lot of the time, the data shows the complete opposite. Together, these opportunities can have as much as 9 to 12% impact on net profit margins. And this is exactly the opportunity that we'll be going after in this presentation. Okay, welcome everyone. I'm Nate Littlewood, and over the next hour, I'm going to be sharing with you 3 CFO secrets that can boost your profits by 5% or significantly more using strategies that I have used now with dozens of different 7-figure e-commerce and CPG founders. So these are not theoretical concepts. These are approaches and systems that I've tested, learned the hard way from my time working on Wall Street, but also implemented and practiced at my own 7-figure e-commerce business. By the end of this session, you'll have a clear roadmap to optimize your inventory purchasing, eliminate profit draining overheads, and also focus on your most profitable products. Just as a bit of an introduction before we dive in, I spent about a decade of my career working on Wall Street at an investment bank, basically analyzing and valuing businesses and their financials. So although I have spent a lot of time valuing businesses from the outside, I've also spent time in your shoes. So in 2016, I launched my own e-commerce business called Urbanleaf, which we bootstrapped into a 7-figure company. So I know what it's like to be juggling inventory decisions, managing cash flow, and trying to figure out which products you should be focused on. These days, I work as a fractional CFO, basically helping founders like you build more financially sustainable businesses. Basically, I've been in your shoes. I know what it's like to be, running a business like this. And the strategies that I'm going to be sharing with you today have been tried and tested both in my own business as well as the clients that I work with. So that's how I spend most of my time. I did also recently launch a podcast. It's called Profits on Purpose, in case you want to check it out. Okay, so just wanted to give you guys a bit of an overview of what we're actually going to be talking about today. So after looking at dozens and dozens of e-commerce businesses over the last few years, I've noticed a few recurring patterns in terms of profit leaks and money that these founders are inadvertently just wasting. These financial blind spots seem to keep showing up time and time again with, quite honestly, a little bit of a scary frequency, which is why I wanted to put this presentation together. So the first problem I see is that founders tend to approach their inventory decisions without really understanding and taking into consideration the full costs of carrying and owning that inventory, which for businesses like this can get very, very expensive very, very fast. The second issue is related to indirect and overheads. Basically, these costs can creep up over time, and often I see situations where they're consuming 20 or 30% more costs here, and profit erosion than we really should be. The third issue that I run into a lot is that I believe a lot of founders operate in a belief that more products equals more profits. And what I'm going to be talking about later in this presentation is showing you why often the exact opposite is actually true, and that a lot of times we're actually eroding our profitability by adding more products. So what we're going to be going through today is each of these 3 different profit leaks, and I'm going to be showing you how each of these is destroying your profitability and giving you some ideas about how to fix them. So let me put some real numbers and context around this before we go too much further. These are just high-level estimates so that you can start to get a little bit of a feel for the magnitude of the numbers that we're talking about here. So for a business that's doing, say, about $2 million annually in sales, which some of you might be at, or hopefully you're approaching in the not too distant future, poor inventory financing decisions can very, very easily be costing these businesses $35,000 to say $80,000 per year in profit. And that profit is being consumed by unnecessary inventory expenses, often being charged on unnecessary inventory. So in other words, we have too much inventory, too much debt, and therefore too much interest being paid for this stuff. Another big source of leakage relates to overhead creep. For a business this size, it wouldn't be uncommon to find $40,000 to $60,000 of wasted overhead spend. And another area where I often see opportunity is around the product mix, right? So that could easily be $100,000 for a company of this size. So when you add all these things together, you're going to get something in the order of about $170,000 to $240,000 a year. That's a 9 to 12% of margin. That's 9 to 12% of your revenue, and that is exactly the opportunity that we're going to be talking about and going after in today's presentation. So that's kind of setting the stage here. What I'm going to do now is dive into secret number one. I want you to think about every time you are purchasing inventory, you're basically going to the casino and you are placing a bet. Let's say that you're putting down maybe $25 to $30 for your cost of goods sold, right? That's essentially you buying into this bet. Now, if everything goes your way and you win this bet, you might get back about $60, okay? That's your selling price, right? That's the proceeds from essentially winning, being able to sell the product to the customer. Now, that's roughly 2 to 1 odds. And let's face it, 2 to 1 odds are okay, but they're not amazing. It's certainly not the sort of return that you're going to be able to retire off. You're going to need to do that consistently and repeatedly over time if you actually want to create wealth, build value, and grow your business. But here's the problem that most founders don't really consider when they're going through this scenario, is they don't think about what would happen if you were playing with borrowed money. So what if the casino is actually charging you interest on every single chip that you put down? Well, the reality is that that changes the odds very, very dramatically. And unfortunately, given the very, very heavy dependence that a lot of these businesses have on debt financing, this is exactly the situation that we find ourselves in. So a lot of founders basically go into this thinking, hey, the bet I'm placing is $30 down, right? That's what I'm paying for my COGS. I might get $60 back. Therefore, I have a 2 to 1 ratio, and my profit opportunity is $30. Unfortunately, this is not actually the game you're playing. The game you're playing looks a lot more like this, right? So if you were hypothetically sitting on 9 months worth of inventory here, then 9 times that $30 worth of costs would be $270 worth of inventory. If we assumed that you had an average APR on that, or average interest cost on that, of about 40%, then that's going to be equivalent to about $108 per year, or $9 per month, right? So we've removed $9 of our margin, or our winnings is going straight to interest. Plus, you have to pay for overheads. And by the time you include the $9 for interest and the $25 for overheads, there's actually nothing left. And we actually don't have any winnings at all. And essentially, the point I want to make here is that way too many founders assume that they're playing the game on the left, but in reality, they're playing the game on the right. And we need to understand the actual game that we're playing and the rules of the game and how the math works if we're going to be a chance to win. So the mistake that I see founders making, like time and time again when it comes to this stuff, is that they're making basically their purchase decisions by only really looking at and thinking about the gross profit portion of their income statement. What I mean by that is that they're comparing the revenue that they can receive with the cost of goods sold. And as long as revenue take cost of goods sold is a positive number, they're likely to go, fine, okay, that's a good deal. Let's make that trade. Let's take that bet. But the problem is that the profit that your business generates and the drivers of profitability for your company are a good deal more complicated than that. What you're actually looking at here is a waterfall chart, which basically starts with income or receipts on the left-hand side. And essentially what we're doing is basically flushing that income or that revenue through the entire income statement, basically going from the top of the income statement down to the bottom on the right-hand side. So you start with all of your direct product costs, and that's what's generating gross profit. But after that, you'll see we've got everything between G&A over to the fixed marketing costs. These are all of our overheads. That gets us down to EBITDA. And then, finally, we're getting down to profit before tax over here. Now, the important takeaway that I want you to make here is that in 2024, early stage e-commerce businesses were only generating about 8% EBITDA margin. This data is based off over 1,000 comparable companies, and this is data collected from Finaloop, the accounting platform, right? So 8% profit margin. That means if you've got a $100 product, you're only left with about $8 worth of EBITDA. Just remember that number for a second. So what we really need to be doing here is thinking much more holistically about the financials and understanding not just whether or not this is a good decision at the gross profit level, but does this make sense right the way down to the net income level, okay? So that 8% number that I just mentioned, what I wanted to show you on this chart is basically how quickly that 8% EBITDA margin can be eroded. What you're looking at here is the annual interest expense of an e-commerce business that has annual cost of goods sold of about $45,000. In other words, I'm basically showing you this exact business here, right? The product cost over here, this big orange bar, that's $45,000, okay? So that's the business that we're talking about. So what we can recall from the previous slide is that business was only left with an 8% margin, or in other words, about $8,000 worth of EBITDA. So that basically means for any combination of inventory coverage and APR, where we have more than $8,000 worth of interest, basically all of that income is being given to the financiers. We're generating a net income loss under all of these scenarios. So essentially what I'm talking about is all of these scenarios in orange here, right? All of the scenarios in orange are scenarios where we have more than $8,000 of interest cost. And we know from the previous slide here that anything more than $8,000 of interest cost is going to drive us down to basically zero in terms of net income, okay? So that's the challenge that we're dealing with. Now, I'm just going to pull out one example here, which is on the 50% APR row. What you're looking at here is a situation where basically a 3-month drop in inventory coverage, going from 9 months of inventory down to 6 months of inventory. That move alone would save $5,000 a year worth of interest, okay? The title of the presentation today was 3 CFO secrets to boost your profits by 5%. So even though we're on secret number 1, we've already got a 5% profit opportunity right here. So before we move on to the next secret, I just want to take a minute to kind of talk about how we often find ourselves in this problem. And in my experience, the path that gets us to this point often looks a little bit like this. Basically, we have a founder who's experienced a stock outage. The stock outage was painful and annoying. It was not a pleasant experience. So we go and over-order inventory because we don't want to repeat that experience. It wasn't fun. We rationalize this to ourselves by saying, well, if I order more, my unit costs will go down, which will boost my profit margins. So that must be a good thing, right? The problem is that we forget about the other side of the equation. And the additional inventory means more debt means more interest. In addition to the additional debt, we also have to pay for more storage, warehousing, and we might also have some issues with product obsolescence, and we become a far less nimble company because we're sitting on so much inventory that we can't implement customer feedback very quickly. So that's kind of the death spiral that I see a lot of businesses kind of falling into. I guess the takeaway here is that you need to understand that there is an alternative side to this inventory game. So yes, I know that having too little inventory is painful. I know that stock outage is annoying. And I know that it's not fun dealing with angry customers wondering where the product is that they wanted to buy. But you mustn't lose sight of the fact that there's also some very, very big and significant costs on the other side of this coin. And oftentimes the costs of having too much inventory, which I would say 90% of the brands that I look at do, they have way more inventory than they actually need. These costs can be very, very significant and very, very costly. So if you are thinking that you might be working at or for a business that's having an issue like this, then there are a few action steps that you can take. First of all, you want to calculate and know what your APR is. You should audit the current inventory levels by SKU. You should calculate your average month of stock on hand by SKU. You should model your financing costs into your SKU level unit economics. And you should set up inventory turn targets based on either product or category. Okay, on to secret number 2 here. This one is about overheads. And as you're probably aware, over time, businesses tend to accumulate overheads, a little bit like barnacles accumulate on the bottom of a ship's hull. Could be a SaaS subscription here, a consultant there, an upgraded plan that you completely forgot about, or maybe a service that you tried once and then never actually got around to canceling. Individually, these costs are often small, but collectively, they do compound and they add up over time. And in many cases, they can add up to your overheads and bloated indirect costs to the tune of 20 to 30% more than what they really should be. I very, very commonly see founders who have not systematically audited their overhead expenses in years. They often just accept these costs as, hey, it's just the cost of doing business and I need to pay for all this stuff to kind of keep the lights on. But what I wanted to do is challenge you and suggest that there might be a more systematic way to eliminate these profit drains without hurting your operations. So most businesses do what we call traditional budgeting. They essentially look at last year's expenses. They might add some growth percentage to that. It could be 0, maybe it's plus 10%, whatever. But basically, they'll take last year's budget, they'll add it up or down, a few percent, and they'll essentially then go and call that the new budget. An alternative approach is what we call zero-based budgeting, or ZBB, and it works completely differently. Instead of starting from last year's numbers, what we do here is basically force everything to start from 0. So every SaaS subscription, every service provider, every recurring cost has to generate an ROI and it has to prove its worth. So yes, this is time consuming and it does require an investment upfront to actually be able to do this. But I have yet to take a client through this process and found anything less than about a 15% reduction in their overheads. So this is usually a very, very high ROI use of your time. There's another way to hack this. I don't necessarily recommend this in all cases, but if you wanted to just dive in and get started really, really fast, cancel your credit cards. Maybe twice a year, just go through and cancel all of the business credit cards. Yes, it is going to be an administrative pain in the backside. Yes, you are going to have to go and set up a whole lot of new, automated payment information. But it forces every single vendor and service provider that you work with to reach out to you if they want to get paid. And suddenly you're basically forced into a situation where you need to make a decision to evaluate whether each of these expenses is actually worthwhile and needed. And you will be amazed at how many of these subscriptions you're just not using. And frankly, you don't need anymore. And I would argue that yes, this is an admin hassle. It might cost you a day or two of your time, depending on how big your business is. But the profit improvement that you're generating here, and that you can carry forward into future months, is probably worth the time for a lot of you. If I had to identify the single biggest category of wasteful spending in businesses like this, without a doubt, it's going to be marketing widgets. I commonly see founders with subscriptions to things like Triple Whale. They've got dashboards, they've got various Shopify plugins, they've got email marketing platforms, you name it. There might be a landing page builder that they used once and then forgot to cancel. They're often spending thousands and thousands of dollars a month on these things, but when you actually ask them, what do they do and what are you using these things for, a lot of the times there isn't a great answer. These are often shiny objects and they were fun and exciting to play with at one point in time, but now they're just draining your profit. The flip side, this is a little bit of a tangent here, but since we're on on the topic, the flip side, one area where I think founders dramatically underspend is inventory management and supply chain optimization. It is insane the ROI on some of these tools. And particularly with AI making marketing easier and easier, and the gap between people who can and cannot do marketing naturally kind of closing, marketing is going to be AI is basically going to be an enabler of essentially commoditized customer acquisition. And so the gap between the brands that can and cannot effectively market and acquire customers is going to close. And I think what that means is that we're going to move into an era where the competitive advantage and the differentiator for a lot of these brands is no longer going to be about marketing and customer acquisition. In my belief, it's going to come down to product, operational excellence, supply chain, and just doing the boring things really, really well. So if you spend, I don't know, a lot of these tools only cost like $1,000 a month. And for the $2 million a year business example that we were talking about earlier, it's not at all difficult to imagine a tool like this saving $100,000 a year in inventory. In other words, you could reduce your carrying inventory balance by about 100K. So if you can reduce an inventory balance by 100K with a piece of software that costs $1,000 a month or 12 grand a year, that's basically like an 8 times ROI on a one-year basis, right? That is an unbelievably good ROI. And it's why I think, a lot of founders should be spending more money here than they are. So here's the framework that I use for auditing overheads with my clients. Basically, what we want to do is examine the overhead expenses in 6 categories. We're going to look at SaaS and software, marketing tools, professional services, logistics and fulfillment, office and admin, and then personnel costs. For each of these categories, we basically want to ask 3 questions, which is, what is the measurable ROI? Is this thing still necessary for our operations? And can we get the same result for less money? The way that I have done the zero-based budgeting with some of my clients is we'll basically go through all of the indirect costs and assign someone on the team as the owner of every single expense. And that person's job, usually there's some sort of threshold. So if it's above, X dollars per month or X dollars per year, whoever's the owner of that expense then has to basically build a case and present it to the rest of the team as to why we still need this product or service. You might also want to add in here a step to go and find a couple of alternatives. So yes, we still need this analytics tool, but I found these 2 other alternatives, and I actually think this other tool is a little bit cheaper, could be a better fit for us. So I'm going to recommend that we switch to that, okay? A very common scenario that you might see when you go through this. So the goal here is not to cut your expenses. We're not trying to get everything down to 0. But what we do want to do is make sure that every dollar has a job and every dollar is working as hard as possible. If you wanted to have a go at actually implementing this in your startup, here's a 30-day cost-cutting sprint, basically a roadmap that I would recommend you go through. In week 1, go to your bank, download the last 12 months worth of transactions. Use some categorizations and lookups and formulas in the spreadsheet to basically categorize everything and put it into the buckets that we mentioned earlier. In week 2, you want to go through and audit all of your SaaS subscriptions. Cancel any of the unused ones, downgrade unnecessary plans, and negotiate annual discounts. Remember that the unit economics of a SaaS business are completely different to your consumer products business. These guys have got very, very high margins and low fixed costs. And so generally speaking, the profit that they make on an incremental customer is going to be close to 100% of the revenue that they're generating, okay? So even if they were to give you a 50% discount on your SaaS subscription, there's a good chance that they are still very, very profitable businesses. And in fact, some of the SaaS businesses that I've used, like Adobe is a great example of this, is they basically give you a downgrade option as soon as you try to cancel. So you cancel the subscription and they will give you a better pricing offer while you're walking out the door. So in week 3, basically you want to review all service providers and professional services and calculate the ROI and renegotiate where possible. In week 4, you're going to go and implement all the changes and set up tracking to maintain these optimizations going forwards. Like I said, most clients that I've been through this process with have seen 15 to 20% reductions, and I think it's possible to get a pathway to that level of reduction in as little as 30 days. Okay, so let's talk about secret number 3 now, and this might be the most important one of the lot. So over the years, I've been looking at a lot of different businesses, and one of the favorite metrics that I've come up with over this time is revenue per SKU. And of the dozens and dozens of businesses that I've looked at in the last couple of years, I have seen revenue per SKU range all the way from $5,500 up to about $7 or $8 million per year. Just think about that range for a second. That is over a 1,000 times difference in terms of the amount of revenue that these businesses are generating for every single product. Here's why that's a problem. Every product that you develop requires a significant investment in time, money, and energy. You have to engineer it. You have to design it. You have to create packaging, build listings, shoot photography, write sales copy, develop marketing assets. The list goes on. So whether that product's generating $6,000 a year in revenue or $600,000 a year in revenue, oftentimes the upfront investment in order to bring it to market is going to be about the same. So the question that we're essentially faced with here is, how effective are you at monetizing that investment in product development? And I would argue that if you've got a business that's only generating $6,000 a year per SKU, then it's incredibly unlikely that you're going to be able to pay for all of those upfront product development costs. In my experience working with many, many different founders, they tend to fall into one of 3 categories. The first category is your product-centric founders. These are often creatives or subject matter experts. They love developing products. The second type is the marketing-focused founders, and these people are at home in their Meta ads account or their Facebook ads account. They love Google Analytics, and they usually have a pretty good understanding of things like CAC and LTV. The business owners are the third category, and they tend to take a much more holistic view of things, and they're usually a lot more willing to delegate. The SKU proliferation problem, or the revenue per SKU problem that I mentioned earlier, is most common with the product people. These people have an unhealthy tendency to think that more products equals more revenue. And they fall into the trap of believing that more choices equals more sales. If I just give the customers another widget to choose from, then they're more likely to buy. The problem is that the data actually shows us the exact opposite is often true. There's actually a famous study called the JAM study that perfectly illustrates this example. Researchers set up a jam sampling stand inside a supermarket, and they initially put 6 different flavors of jam on the table. They would give people coupons so that they could track how many people actually bought a jar of jam. They then repeated the experiment, but on the second time, instead of 6 jars of jam, they had 24 different flavors. Now, the hypothesis here was that by giving people more choices, they would have more sales. Wrong. The exact opposite happened. More choices created a phenomenon called cognitive overload, which basically means that people were fearful of making a bad decision. And when people become fearful of making a bad decision, they have a tendency of making no decision at all. And that means 0% conversion rate, and they are not buying your product. The same thing is happening here with your product portfolio. More SKUs often means lower conversion rates and more confused customers. I actually want to share with you a couple of real life examples of this concept. So the first one is a woman named Magdalena. I actually first started working with her a bit over a year ago. And when she first came to me, she had over 50 different SKUs for her women's supplement company, which is called Wellina. And they thought that more SKUs represented more opportunities. And they figured that, hey, there's more ways that we can solve the customer problem, therefore they're more likely to buy from us. But when we analyzed the data, we discovered that there were just 9 core products, which were generating over 80% of her profit. The other 40-something products, they weren't just low performers, although some of them were actually losing money. But there was a lot of stuff in the middle that was just meh. It wasn't really, doing much in terms of profitability. But what it was doing was making the business significantly more complicated to run, right? They had a more complicated warehouse. They had more complicated procurement, all this different packaging, all these different listings. And what we've been doing over the last year or so is basically getting her down to a core product catalog of just 9 products. And interestingly, those 9 products do a pretty good job of solving all of the original customer problems. So they really haven't lost that much revenue, but they're starting to see dramatic increases in their profitability. The next example is a founder I met about a month ago, actually, and he owns an Amazon business selling boat covers, amongst other things. Anyway, one of his boat covers, which looks a little bit like this, he's got a listing that was generating about $20,000 or $30,000 per month in sales. And the founder thought to himself, well, I'd love to increase my revenue. Why don't I give customers some more choices? Maybe if I can give them some different colors, they might be more likely to buy. So he added 4 new color variants. He added a blue, gray, red, and green. It doesn't really matter. And he expected that with additional options and additional choices, he would be able to increase his sales. Ideally, 5 times would be great, right? But you want to know what actually happened in this case? His sales only increased by about 10%. It turned out that customers really didn't care what color their boat cover was. They just wanted to make sure that it didn't get water on it, okay? But now the business has got 5 times the complexity. It's got 5 times the inventory management headache. It's got 5 times the photography costs, and all for a 10% increase in sales. Was that really worth it? Probably not. I suspect we didn't actually get into it on the conversation, but I suspect his profitability for this listing has actually decreased as a result of adding these additional options. So here's how to do the analysis on revenue per SKU and looking at your product portfolio if you want to apply this for your business. For every SKU, you basically want to calculate 5 key metrics. You want to look at your annual revenue per SKU, your gross margin percentage, your inventory turn rate, your marketing efficiency, and the total contribution margin after all of these costs have been allocated in. Once you have this data, you can classify your products into basically 3 tiers. You're going to have champions, which are your high performers across multiple metrics, and these should get maximum investment. Then you're going to have contributors. These are solid performers that you can maintain, but you don't want to invest in them too heavily. And then you're going to have challengers or underperformers. And these ones that you basically need to either fix or eliminate them. Once you've classified the products into one of these three categories, here's what you need to do. So the champions get the majority of your attention and investment. They're going to get increased marketing spend. They're going to get supply chain optimization. They're going to get inventory investment. And they also might get new product development in adjacent categories. The contributors, you basically maintain, you keep them alive, but you don't really want to invest too much in them. Then the challengers, they have basically 90 days to prove their worth, otherwise they're out. They get eliminated, you drop them. So the key insight is that most of your profits are going to come from your champions. So you need to allocate your limited resources accordingly. Most founders spread themselves too thin, and most founders also make the mistake of allocating their resources equally across each of these three categories of products, which is a guaranteed path to mediocre results. You need to be allocating your time, your resources, your marketing budget, your product development, everything else proportional to the amount of profit that these three categories are actually generating for you. So to recap here, guys, and kind of draw things to a close, here is your 90-day action plan if you want to put some of these ideas to work. Month 1, days 1 to 30. You're going to focus on secret 1 initially. You're basically going to go audit all your inventory levels, calculate your true financing costs, and optimize your purchasing decisions. Month 2, we're going to get into secret 2. This is when you will conduct your zero-based budgeting exercise. You will do an audit of your overhead costs, and you will eliminate all of your profit drains. In month 3, we're going to look at secret 3. This is where you will analyze your product portfolio, identify champions and challenges, and make your tough focus decisions. If you implement these changes systematically, you should see about a 5 to 15% profit improvement within 90 days, with the benefits basically compounding over time. Let me paint a picture for you of what your business looks like after implementing these three secrets. So instead of a scattered focus across dozens of different products, you're going to get laser focused on your champion products. Instead of hidden profit drains eating away at margins, every expense is going to be optimized, justified, and you will have an ROI argument of why all these overhead expenses need to be there. And instead of finding yourself in a situation where you're basically working for your lenders and all of the hard work you're doing, generating gross profit, basically going to the people who lent you money, what we're going to do instead is you'll start to get to keep some of these profits for yourself and your business. Now, like I said at the beginning, for a $2 million business, we're typically talking about $170,000 to maybe $240,000 in annual profit opportunity. Obviously, that range is contingent upon how the business is being managed today. But the point is that it's very, very easy to find a pathway to at least 5% in terms of profit enhancement opportunities. So if you guys are thinking that, this makes sense, but I would like to get some help implementing it, I've got three ideas that we could possibly work together. The first, if you're a DIY type, I've got a bunch of free resources online. Just go to my website /freebies, as you can see on the left here, and you can download a whole lot of courses, content, models, templates. There's even a free cash flow forecasting model on there and a video where I walk you through how to use it. Second, I run a private mastermind group. This is much more affordable than working one-on-one, and it gives you peer support and group coaching. The third option for founders who are ready for hands-on implementation is that I do work with a small number of founders on a fractional one-on-one basis and help them build actionable roadmaps to achieve their financial goals. I'm going to include a link below if anyone would like to book a meeting. We can do a free 15-minute strategy session, and I can help you figure out which of these options might be best for you.